not gonna spend again too much time. I believe I spent more than enough time in the class. The cost volume profit analysis, it's a very, very interesting tool in order to show you what is the proper amount of sales as a dollar sales and proper amount of sales as a number of units in order to you to reach this point, at which point you cover all the cost, and after that you can start making profit. Analysis, we're going to change the effect of the cost and the volume of the company. Management decision and the profit planning, we're going to use for the management decision profit planning. And again, remember, we're trying to stay on something which is stable. Stable mid flat line. We're going to chase which of the cost variable and fixed behave as a flat line, and that would be variable cost per unit and the fixed cost in total. Now, assumptions is the cost and the revenue are assumed to be linear, so that means they behave that way. So variable cost per unit is always stable. Fixed cost per total fixed cost is always stable. All the costs you classify under variable and fixed. There's no mixed cost. There's nothing else. Just variable and fixed. And the changes of activity is the only thing that drives the cost. Inventory start with 0, finish with 0. So there's no change in the beginning balance and end balance. And if we have more than one product, the product mix stays the same. This is prepared only and only for the internal purposes, which classify all the costs, either the fixed and end. Then we're going to come up with this contribution format income statement. So the statement is going to look like the sales, variable cost, variable cost, variable cost, contribution margin, fixed cost, fixed cost, fixed cost, operating income. This is one example that we can have here. Unit selling price per sales one is $500. Variable cost is $300. Fixed cost is $200,000. Units that we're selling 1,600 units. So what we can take, our units price is 500, variable cost 300, our contribution margin per unit is $200. Since we're selling 1,600 units, how much these units contribute to our company? They contribute in total $320,000. $320,000, is it enough to cover our fixed costs? Yes, it is. In fact, it's going to give us $120,000 more. So we can enjoy it. As you can see, $120,000 more. Now the question is, what is our break-even? Well, the break-even will be, let me see if I can flip this calculation. Just give me a second. Get this. No, it's not going to work like this. Or maybe it will. Just give me just a second. See if I can flip this information on the Excel. Yep, I can flip it. Expenses, I'm trying to make it very, very, very simple. So you can easily see it. That will be 300 here. And then I'm going to give you my screen. This is the information that we have. We have our sales price, which is $500, and we have our total variable cost, which is $300. We have contribution margin $200 per unit. Now the question is, what's going to happen if we sell 1,600 units? That's what we're chasing here. Let's format everything. Oof, that's too much. That's way too much. So what's going to happen if we sell 1,600 units? Well, obviously, if we sell those units, we're going to have total revenue of sales of $800,000. Our variable cost will be $140,000, and that's going to give us contribution margin of $320,000. So how else we can get those $320,000? Very simple. That's 160 times 200 is going to give us $320,000. After that, we have the fixed cost, which is the fixed cost. That's not going to change. And once we get that fixed cost, we can get our operating income, which is the contribution margin minus the fixed cost. And we're going to get $120,000. Just to make it more presentable, that's what we can do. And that will be like this. So we get our stage when we're selling 160,000 units. Now the question is, where is our break-even in this case? Well, the break-even we set will be equal to it's a number of units. Number of units will be equal to our fixed cost divided by contribution margin per unit, if you remember. So I have my contribution margin per unit, which is 200, and I have my fixed cost, which is 200,000. So what I have to do is just to apply the formula, which is the number of units, to be equal to this number divided by that number. So as long as I sell 1,000 units, that will be enough to cover my fixed cost. So let's see if that actually is correct. Let's sell this 1,000 units and see what's going to happen. We're gonna apply the formula 1,000 log this sales time 500. That's gonna give me 500,000 units, $500,000 sales. That will be related to once I sell 1,000 units, we'll time $300 per unit. That's $300,000 variable cost per unit for the 1,000 units. That's generate me contribution margin of $200,000, which is exactly what I needed to cover my fixed cost. And in that case, my operating income will be exactly at the break-even or zero. This is the formula that we saw last time in the classroom. So that's how we're getting that break-even point. Now, what else we can get from here? We can easily calculate the percentages. How much is a percentage? What's the ratio between the sales, variable cost, and the contribution margin? Remember, sales are always 100%. Now the question is, how much is the variable cost as percentage of sales? That will be 300 divided by 5, and this will be as a percentage. That will be 60%. So what's left for the contribution margin? To be 40%. And once we have this ratio, we can easily apply it everywhere, and we'll see that regardless of the number of units that we're selling, we always get the same ratio between variable cost and contribution margin. Why is that? Because we're not changing the cost per unit. The only thing that we're changing is the number of the units, which drive in the same pattern the sales and the variable cost. For that reason, we're always going to stay in the stable environment for the percentage of those costs. Once we know that, we can easily calculate the sales that we need to get up to the break-even, and the sales for the break-even will be again the fixed cost divided by contribution margin ratio. Or our sales that we need to reach will be equal to, always, it's going to be equal to the fixed cost divided by contribution margin. So in other words, the contribution margin that we need to generate from our sales to cover the fixed cost, it has to be 40% of the sales. How much should be our sales? That's what we're looking for. Remember? So basically, we're chasing this. Our contribution margin should be equal to the fixed cost. Well, the fixed cost is $200,000. Fixed cost is equal to $200,000. How much should be my contribution margin in order to cover the fixed cost? $200,000. But I have to generate now but the contribution margin is equal to the sales time. What is that? Time 40%. Why? Because my contribution is 40% of the sales. How much should be my contribution margin? That's what I'm chasing. And once I get that number, I'm done. This is the calculation for the break-even. Let's stop sharing this and let's go to the slides now. So that was our proof that once we sell in 1,600 units, we can generate operating income of $120,000. For the break-even, that will be cost per unit. For the unit, we generated $200 per unit. So what's going to happen if we sell 1,000 units? If we sell 1,000 units, we generate enough contribution margin to cover our fixed cost. What's going to happen if we sell one additional unit after the break-even? Well, the contribution margin of that unit is going to flow directly to our operating income. What's going to happen if we sell 2 more units after the break-even? We're gonna so that will be 1 unit. So this one, slide-wise, like this, I have no idea. To cover the fixed cost, must sell 1,000 before the operating income, and then this calculation here is not, that's on the 1,100 smartphones. So basically, if I sell 1 additional unit, how much will be the increase my operating income after the break-even? Every contribution margin per unit is going to flow to my operating income. Let's try and tell me, what do you think about this? How can I increase the contribution margin if there's no other changes?
The variable cost decrease.
Any other suggestions? Is the fixed cost related to contribution margin?
No.
Is the sales price related to contribution margin?
Yes.
Yes.
But if I decrease the sales price, am I going to increase the contribution margin?
Yes.
No.
No. So let's see. Let's go and check this.
Yes.
The only, listen, if you don't understand it, if you cannot process it, play with the numbers. get here, get this calculation here, which is the one that we need. I need this calculation, and I need to play with that calculation. So I have my sales, my variable cost, and my contribution margin, right? So the contribution margin sales minus the variable cost. If I reduce my sales price, 450, what's happened with my contribution margin? Is it going up or going down?
Okay, it's going down.
It's going down. So,
Now,
all right, reducing the sales price, is it going to help me to improve my contribution margin? Obviously, it's not going to help me, right? Let's see. Let's put it this way, and here, and let's put it parallel, and so we can see it. So, if I reduce my sales price to 450, my contribution margin is going down. That doesn't help me. So what's the other option? The other option will be to decrease,
reduce variable cost.
to reduce my variable cost. 500, that's my original stage. If I reduce my variable cost to 200, did I improve the contribution margin?
Yes.
Yes. So in that case, what will be the right answer?
D.
Variable cost. If I decrease the variable cost, contribution margin is going to go up. Right, great. So contribution margin ratio, we already know how to calculate. Contribution margin divided by the contribution margin divided by the sales price, and it's going to give us that contribution margin ratio. What we can do with the contribution margin ratio, we can calculate how much sales we need as a dollar amount in order to reach the break even. The other thing that we can do is with the ratio, we can explain ourselves for every dollar of sales, how much we're going to get. For every dollar of sales, as we already said, we're going to get 40 cents. 40 cents is going to flow to our income. Let's see, contribution margin is what? How we calculating the contribution margin?
Sales revenue less variable expenses.
Yeah, obviously. As you can see here in the formula, we have only sales minus the variable cost, nothing else. Where is that Excel spreadsheet? Right here. So as you can see here, contribution margin is sales minus the total variable cost, nothing else. There's no fixed cost, there's nothing else here. So all the other options, we can throw it in the garbage. Everything that says fixed cost, throw it in the garbage. Fixed cost, garbage. Sales revenue less cost of goods sold. We do not even talk about cost of goods sold. So garbage. Break-even analysis is the process to finding the break-even point, at which point we generating enough contribution margin to cover our fixed cost. Obviously, we can express it with that mathematical equation, where the selling price per unit is going to have to be equal to the variable cost per unit plus the total fixed cost. And once we solve the problem, the formula, we're going to see that the break-even is 1,000 units. Once we sell 1,000 units, fixed cost divided by unit contribution margin, we're going to be at break-even. Can we get that break-even as a dollar sales? Yes, we can. But we have to use they don't use in here a unit contribution margin per unit here. We have to use the contribution margin ratio. So remember, on the break-even, nominator is always fixed cost. Denominator depends. Either it's going to be contribution margin per unit if you want number of units. Either it's going to be contribution margin ratio if you want to see total sales. The graphic presentation, it looks like this. The one that we saw in class. Fixed cost is a fixed cost. Once the sale starts, variable cost also starts until the sales reach the point of which point they cover the fixed cost and the variable cost. Once they cover the total cost, now you're in the profit area. So which of the following will represent how the break-even point of unit is calculated? Do I care about net operating income? Is the net operating income part of my formula?
No.
No. B and D gone. Now you have A and C. What we chasing? Units. If we chase units, what we chasing? Units. So which one will be the right one?
C.
The one that have unit, right? The
Yeah.
one have ratio, that's gonna be something else. And that's how you should remember it. So the target operating income, if you want something to achieve, what you have to do? Add it to the formula, where as a denominator, together with the fixed cost. And that's how you're gonna achieve what you want. Let's say we want to achieve to cover our fixed cost plus $120,000 more. Well, if that's what we want, divided by contribution margin per unit, then we're gonna see that we need to sell 1,600 units. Now, there's a one, if you want to go with the target operating income, the income, as you know, that's after taxes, then we have to think about the tax rate. That will be a little bit more tricky. I may throw you something like this. I may throw you on the quiz. Remember, we have to do quiz. Not this week. This week we're doing the assignment in class. Not next week. I believe for week 8 we have to do the quiz. I mean, you have to do the quiz. So I might throw you a question like this. So for those one who's gonna watch the video later, they know what question I'm gonna chase you at. Target income with tax rate. So what you have to do first is get the income that you want. And the income that you want will be, it has to be after the taxes. So let's see this question. This company recorded net operating income of 51 on sales of 280. If the company variable costs are 60% of the sales, how much is the fixed cost? How we gonna solve this problem? Any suggestions? Are you guys there?
Yes.
So how are we gonna solve this problem?
Divide 40% of the sales price.
So what do we know? So what do I
Variable
know?
We know
I
the
know sales.
price.
Okay.
Yes.
I know the sales. Let's get some formulas from here, and we'll start working with the on some format here. Let's get this format and start working. I know all those things. So what do I know and what I don't know? I know my income, right? How much is my income? 51,000. Correct?
Yes.
Let's put some zero here. I don't know this one. But what I know my sales are 280. Correct?
Yes.
That's how much I know. And I know that my variable cost is 60%. I don't know my variable cost. I don't know my contribution margin. That's all I know. So, can I get my variable cost?
The variable cost is 60.
Percent of that one. So it's gonna be this one time 60%. So can I get my contribution? Can I
160,000.
get my contribution margin? This one, right? 112.
112,000.
So this is the operating income that I'm getting. Can I get my fixed cost? This one minus that one, I'm gonna get my fixed cost.
61.
61,000. Make sense?
Yes.
All right. Let's see if that's the correct answer and move on. It should be the one, right? There we go. That's the one. Now the difference between the actual and expected sales and the break-even, that will be your margin of safety. Where am I compared to the break-even? So for example, if I'm currently sales are 750, but at break-even I'm at 500, so that means I'm $250,000 over my break-even point. So margin of safety is $250,000, or as a percentage is 33%. Why? Because again, I'm $250,000 and currently I'm $750,000, so that's 33% higher than margin of safety. Let's see what you can say on this question. What would be the right one?
Among the rich operating.
Is our calculation here based on the break-even? Sorry, on the net income?
No,
No. What is based on?
sales.
Sales. What would be the right one? Margin B.
B.
Okay, data analytics. On the data analytics, we have to analyze that raw data, and then we're going to use the cost volume profit analysis. So, how the change in business is going to affect our break-even? The cost volume can help management to analyze and respond to the changes in business conditions. Say, let's say the company selling tablets starts off with the current situation. They have selling price 400, variable cost 200,
Okay.
contribution margin is 200, fixed cost is 1,800, and the break even is 900 or 360 units of sales. So now, if they add a new piece of equipment, the production line will reduce their variable cost by $20, but the fixed cost is going to increase. This new equipment will be able to company to add the new feature that tablet, result in the new sales price of 450. So as you can see here, what we're changing pretty much everything. We're changing the selling price with $50 up, variable cost with $20 up, and we're changing the fixed cost. What's going to happen now with the break even? That's the question. So 450, 180 is going to give us a contribution margin per unit, 270. Now the fixed cost is gonna go with 60,000. That's gonna go to 240. So how many units now we need to sell? 889 units. So once we're selling 889, are we in better situation than we used to be? We used to need to sell 900. Now we reduce our break even to 889. Is that good for us? Is it good when we're reducing the number of units to reach the break even?
Yes.
Yes. Why? Because we're reaching break even faster. Make sense? On the sales mix, once you have the sales mix, now what we have to do is we're gonna ignore the contribution margin per unit, and we're gonna go to the total contribution margin. So let's see, we have two basic. We have the smartphone and we have the TVs. We have the selling price, we have the contribution margin per unit, and we have the sales mix on the units. So what we're gonna do, we're gonna get the unit contribution margin for the smartphones, which is 200 times 75. And then we're gonna get the unit contribution margin for the TV, which is 500 times 25. And we're gonna get the total contribution margin, which is 275. And we're gonna go with that contribution margin based on the fixed cost, which is 275. And we're gonna calculate that we need to sell 1,000 units. So out of 1,000 units, how many units belongs to the smartphone and how much belongs to the TV? Well, since 75% of the sales belongs to the smartphones, 750 units have to go to the smartphone, and the rest 250 units goes to the TV. That's how we're calculating the sales mix. Nothing more, nothing less. So again, we're getting the indoor, outdoor, come up with the company total, working with the company total contribution margin to come up with the break even. In this case will be zero sales mix percentages will be 20 and 80. So we're gonna get contribution margin ratio is 40% times 0.20. And then we're gonna have 30% times 0.80. It's gonna give us a weighted average contribution margin 0.32. Or 320 divided by 1,000 is again is 32%. And then we're going to apply the 32% to get the break-even point of sales. Once we have the break-even point of sales and I have how much is my sales mix, 20% goes to the indoor and 80% goes to the outdoor. Those units have to come, 20% of those units have to come from one and the 80% from the other. And that's how we calculate it. Tell me what you think about this question. Yes, obviously, that one will be B. And the next one is the cost structure, which I show you in the class, where the one company is more exposed to the variable cost versus the other one, which is more exposed to the fixed cost. And that is related to the operating leverage. So means if I change my sales with 10%, how much is going to flow to my operating income? And that will be the last thing for today. Yes, yes. Again, get ready, get prepared, and the APA format. Sorry?
Not only is it
On the APA format, again, to make it clear, APA format, I don't expect that APA format. So that means I don't expect any citation, quotation, on anything on that area on your work. If I see any citation, quotation, I actually is going to deduct your marks. Don't use ChatGPT because they're going to chase you for ChatGPT. If they find ChatGPT in your work, or artificial intelligence or anything like that, you're going to get 0 marks. Okay?
That's fine.
So try, do what you can do. I want to see your work. Even if you make a mistakes, then we're going to talk about it and then how to improve those mistakes and how to get better. Don't forget you have one more case to do, but that will be in the groups. Okay?
Yeah.
Okay, guys. Thank you for today. Enjoy the rest of your day. We'll see each other on Thursday.
Thank you, Professor.
Thank you, guys.
Thank you, Professor.
Thank you.